Welcome to The Explainer. Today, we're putting on our expert investment analyst hats and running Uber's massive Q2 2026 financials through a real gauntlet. We're not just skimming the headlines here, we're going to rigorously stress test this tech giant against the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside some modern discounted cash flow models. Here's our agenda. We'll start with the company snapshot, move through the Buffett, Lynch, and Graham lenses, tackle the DCF and alternative models, and wrap it all up with our synthesis and final verdict. All right, Section 1, Company Snapshot. Let's establish exactly where Uber stands today. If your last memory of Uber is just some scrappy, cash-burning startup, it is definitely time to update that mental model. Today, they are a massive $147 billion global mobility, delivery, and freight platform. And this quote brilliantly illustrates that evolution. CEO Dara Khosrowshahi recently announced that their trailing 12-month free cash flow just crossed the $10 billion mark for the very first time. They've literally transformed from a cash incinerator into an absolute cash-generating machine, which fundamentally changes how Wall Street has to value them. Throughout this explainer, we're going to be stress testing Uber against this current spot price, $71.43 per share. Now, keeping that price in mind, it's worth noting this comes on the back of a quarter where gross bookings accelerated to 22% year-over-year growth, blowing right past $58 billion. So the growth is definitely there, but is the price right? Let's find out. Moving to Section 2, the Buffett lens. Let's see how the Oracle of Omaha himself might look at this modern tech giant. Looking at Buffett's checklist, Uber actually passes these qualitative tests with flying colors. The economic moat is undeniably massive. They control 75% of the US rideshare market, fueled by these incredibly deep network effects. As more drivers join, wait times drop, which attracts more riders. It creates this virtuous, highly profitable cycle. And it's translating to a stellar 35.3% return on equity. Plus, their debt is perfectly manageable. They've got $12.7 billion in total debt against $5.4 billion in cash and another $12.5 billion in investments. And perhaps most Buffett-esque of all, management is being incredibly shareholder-friendly here, having recently authorized a massive $20 billion share buyback program. Now, focus on that $10.1 billion number for a second. Uber's trailing 12-month free cash flow serves as a near-perfect proxy for what Buffett calls owner earnings. This is the true underlying cash a business generates that can actually be returned to the owners. For a company valued at $147 billion, generating $10.1 billion in pure owner earnings signals some serious intrinsic value potential. Buffett would definitely be paying attention to this. Section 3. The Peter Lynch lens. We're dialing up the analytical friction now by viewing Uber through a growth-oriented mindset. Lynch loves to categorize companies, so he knows exactly what kind of game he's playing. Well, with Uber's gross bookings up 22%, and specifically its delivery and freight segments both accelerating to 25% growth, Lynch would absolutely slap the fast grower label on Uber. This is a company aggressively compounding its top and bottom lines. But remember, Lynch also demands that you don't overpay for that growth. And that brings us to the crucial point right here, 5.81. That is Uber's current PEG ratio. The PEG ratio takes the price-to-earnings ratio and divides it by the earnings growth rate. Lynch famously looks for a PEG of 1.0 or lower to signal a real bargain. So a PEG of 5.81, that is sky high. Even with the strong balance sheet and incredible category dominance, Peter Lynch would likely rate this stock a hold or maybe even a sell right now, based purely on that incredibly expensive valuation multiple. For Lynch, paying a premium like this is kind of like buying a Ferrari when you just needed a ride to the grocery store. It's just too expensive. All right, Section 4, the Benjamin Graham lens. We're about to strip away the growth narrative entirely and pass Uber through the ultra-strict 1940s defensive checklist created by the father of value investing himself. As you can see, things get pretty rough for Uber here. Sure, it passes the adequate size and financial condition checks easily, but a modern tech platform with absolutely no dividend, it just can't survive Graham's defensive gauntlet. It fails on historical earnings stability because, let's remember, Uber burned cash for years before turning profitable. It has no dividend record whatsoever, and its price-to-book multiple of 5.19 vastly exceeds Graham's old-school limits. Let's actually crunch the numbers on this. To get Graham's exact intrinsic value, we pull Uber's trailing 12-month earnings per share of $4.03. We then calculate a book value per share of $13.76, which is just their $28.2 billion in equity divided by roughly 2.05 billion shares. We plug all of that into Graham's famous formula. And the math outputs a strict Graham intrinsic value of just $35.32 per share. Now, Graham demands a margin of safety, usually around a third off the intrinsic value, so he wouldn't even touch this stock unless it dropped to around $23.50. At the current $71 price tag, Graham would stay far, far away. He'd probably need a margin of safety just to look at a tech stock, honestly. Section 5, DCF Valuation and Alternatives. Look, we have to be realistic here. Graham's 1940s metrics are notoriously harsh on modern asset-light tech platforms. So let's transition to how Wall Street actually models the stock today. Because the exact market-weighted average cost of capital, or WACC, isn't public, we're building a base case DCF using some standard assumptions. Step 1, we take that $10.1 billion in free cash flow and project a conservative 15% near-term growth rate for 5 years. Step 2, we calculate a terminal value assuming the company grows at 3% perpetually after that. Step 3, we discount it all back to today's present value using a standard 9% WACC as our proxy discount rate. Now, check out this sensitivity table we generated. If you look right at the center of the grid, our base assumption of a 9% WACC and 3% terminal growth, the fair value lands at $91 per share. Under this highly standard modern valuation method, the current $71 price tag actually suggests the stock is currently undervalued, offering a pretty nice upside. For an alternative valuation model, let's look at a comparable company analysis. Stack Uber up against its main rival, Lyft, and you instantly see why Uber commands a premium forward PE multiple of 21.4. Uber has a 75% market share compared to Lyft's 25%. But more importantly, Lyft is basically just rides. Uber is this highly diversified, multi-segment juggernaut. They have delivery, freight, and a rapidly growing advertising business that just exceeded a $2.5 billion revenue run rate. And, as any analyst knows, digital advertising carries significantly higher margins than core ride-sharing. It pads Uber's bottom line in a way Lyft simply cannot match. Which brings us to the consensus analyst target price, sitting way up there at $104.48. This aligns closely with our most bullish DCF scenarios. You see, analysts aren't just pricing in today's cash flows. They are pricing in Uber's massive potential in the autonomous vehicle space, where they are actively partnering with self-driving tech companies rather than trying to build the cars themselves. Finally, Section 6, Synthesis and Final Verdict. It's time to bring all of these distinct analytical lenses together. So here is our final scoreboard. It's quite the spread, right? While a strict old-school Graham value investor would require a catastrophic market drop down to the mid-20s just to consider buying, the modern DCF model implies a fair value of $91. And the analyst consensus model sees immense upside potential, targeting $104.48. It entirely depends on whether you view the market through a lens of strict tangible assets or future cash flow generation. To make a real decision, we have to weigh these distinct strengths and risks objectively. On the plus side, Uber boasts incredible free cash flow generation, massive shareholder returns via buybacks, and an enviable position as the likely network of choice for future robotaxis. On the risk side of the ledger, Peter Lynch would definitely warn us about that high PEG ratio. Plus, the company faces ongoing legal and regulatory compliance risks globally, alongside localized headwinds like the recent two-wheel driver supply softness they experienced in places like Brazil. So, balancing all these frameworks, our blended recommendation is a cautious buy for the modern, growth-oriented investor who can stomach the premium multiple. But as you evaluate the stock against your own portfolio, I want to leave you with this final thought to ponder. As self-driving cars become a reality, will Uber's massive scale and 120,000 committed autonomous vehicles make it the undisputed, unavoidable toll booth for the future of all human transportation? Something to think about. Thanks so much for joining this explainer.